All right, welcome back, everyone. Once again, we're starting chapter 4 today. It deals with job order costing and overhead application. I just want to say I was really pleased with the exam scores overall. I think everyone did very well on the exam. So today I'm going to be doing chapter 4. Obviously, we'll get to these slides and try to work through a couple problems just that kind of go relate to what we're covering in the slides, and then we'll try to get out of here a little early if possible. So just bear with me here. We'll try to move as fast as we can. Okay, let's just look at some of our objectives we're trying to cover here. Describe the differences between job order costing and process costing. Identify the types of firms that would use each type of the method. Compute the predetermined overhead rate and use the rate to assign overhead to units or services produced. Identify and set up the source documents used in job order costing. Describe the cost flows associated with job order costing. Prepare the journal entries associated with job order costing, and allocate support department costs to producing departments. Okay, so let's start out with just talking about the differences between job order and process costing. Um, Pretty much they can be these companies can be divided into two different types, right? Job order accounting system or the process costing accounting system. Okay. Job order production and costing. These are pretty much built to order, so it's just like when each unit is separate, so we have to have each individual unit cost as opposed to when they're similar, and that's pretty much long and short of what that is. I mean, you can see here printing, construction, furniture making, all these types of services would be unique to each other, right? So they're going to be the same as you producing these units are different when these units or services are produced, right? So that's when we focus on the actual job itself when they're separate. Um, for the job order production systems, costs are accumulated by job. Um, so it's called job order costing system. Once again, this is when each job or service is different. We're not going to go through how it's used. If y'all are interested, you can do this on your own time. Process production and costing. This is where these firms have like a lot of the same type of products or services, so where the goods are homogeneous, right? So they're a lot alike. Um, for example, here they're saying cement or petroleum, all this stuff. So we know if you're producing cement, then it's going to be the same unless you're just putting in a 50-pound bag or an 80-pound bag or whatever it might be, right? But the actual product itself is going to be the same. Um, So obviously process firms accumulate production costs by process or by department for a given period of time as opposed to just that individual unit, right? So for the job costing for the separate unit, it's by the job, whereas for this one here, for the process, we're worried about a whole department or the whole entire process because they're homogeneous or they're like. So we're concerned about it with the whole group as far as how the costs accumulate. This is going to be known as process costing system. Unit costs are measured using the following equation. So unit cost is just your process cost divided by the total output. All right, this is just a little summary pretty much of what we just went over. This is just the differences between the job order and the process costing. You can see on the left here we have job order costing. On the right we have the process costing. Job order costing, once again, just a variety of distinct products. Cost accumulate by each individual job because each product's different, so we need to know what the cost is to each unique product. And the unit cost, once again, in this case for the job ordering, is the total job cost over the output, which makes sense, right? So we just take the total job cost, divide it by the output, and that'll give us whatever the unit cost is. For the process costing, once again, they're homogeneous products, meaning they're similar or alike, like we said before, like petroleum or cement, something of that nature. In this case, remember, costs accumulate by the process or by the department as opposed to the individual unit. And in this case, the unit cost is the process cost over output. So we can say pretty much they're a lot alike. It's just one's individual, one's for the whole process. So the only difference in the formula here for unit cost is the process cost over total output over the total job cost over output, which makes sense, right? Everyone good on the job order and the process costing, the differences between the two? pretty straightforward. Okay. Okay, normal costing and overhead application. Unit costs are important because managers need to accurate cost information on materials, labor, and overhead when making these decisions. Um, for example, when a construction company bills a client at set points throughout the construction, it's important that the unit costs be generated in a timely manner. So if we have these long-term construction contracts, the way we bill on that is we just make so much progress, and then they're called progress billings. So obviously, if we're going to bill them on our progress, we need to know what costs we have or what our skin in the game is, right? What we've spent in order to bill them, meaning our direct materials, our labor, and our overhead that's going into the overall project. The job order costing uses the normal cost system and will give the company unit cost information it needs. Actual costing versus normal costing. So these are the two most common ways right here for actually costing. And the actual cost system, only actual cost of direct materials, direct labor, and the overhead are used to determine the cost, right? So we're trying to use the actual cost. In normal costing, overhead is estimated and applied. So there's going to be the main difference between the actual costing versus normal costing. Actual, we try to follow with what's actually happening. Normal, we try to just set up a rate to use and just try to apply it for the overhead and estimate whatever the applied overhead would be to try to give us a better reading throughout the year. And we'll get into why the normal costing is going to be more preferred as opposed to the actual costing. So actual costing, several issues involved with using actual costing. Defining overhead costs. So a lot of these overhead items do not have a direct relationship to whatever the materials or direct materials or direct labor do. So how are we actually going to even assign the overhead costs? So it's hard to define them, right? The second issue is uneven overhead costs. So these don't occur evenly over a year. For example, like in manufacturing firms, like around like the fourth quarter or the third quarter, you're going to see probably higher levels of direct materials and labor being produced because preparing for the fourth quarter, which is with Christmas and usually when people are purchasing a lot more items. So there could be differences in when you purchase stuff could change the patterns of what the expenses and the costs would be throughout the period. So it could kind of throw spikes and highs and lows within that. That's why actual costing can kind of be an issue there because you might not get the true data or the true cost using the actual because it's cyclical or I mean it comes in cycles. Does that make sense? So if we use the average, right? If we apply one for the normal costing, then it'll give us a more level cost throughout the year and try to avoid those spikes. Does that make sense? It also obviously does away with trying to decide where everything goes at this point in time. It just allows us to make a more accurate estimate there. Actual costs are used with uneven production. So it says here, strict actual cost systems are rarely used because accurate day-to-day unit cost information is needed on a timely basis. So it's just impractical to use this method for the most part, right? Next is normal costing. Obviously, this is going to solve the problem associated with actual costing. Under the normal costing system, we determine the unit cost by adding actual direct materials, actual direct labor, and then we estimate the overhead, okay? So we know the direct materials, direct labor, we can decide what that is, right? That can be calculated, right? We can figure that out evenly throughout the year. But the overhead is going to be estimated in this case, and instead of trying to see day to day what the actual overhead is going to be. It makes it more simple on a day-to-day operation just to have the rate that we're going to apply to the estimated overhead, and it does away with those spikes and trying to define where the costs are actually associated with. Makes sense? So it says here virtually all firms use normal costing. So between the actual and normal, we know that normal is preferred and it's the most practical one in practice, right? So the importance of unit cost to manufacturing firms. This is a critical piece of information for a manufacturer. Unit costs are essentially for valuing inventory, determining income, and making numerous important decisions. Disclosing the cost of inventories and determining income are financial reporting requirements that a firm faces at the end of each period. So we can see with GAAP requiring the cost of goods sold and the profit based upon these materials, why this would be relevant even internally within the company, because it has to be reported externally as well at the end of the period. In order to report the cost of its inventories, a firm must know the number of units on hand and the unit cost. The cost of goods sold is used to determine income, requires units sold and their unit cost. Full cost information is useful as an input for internal decisions as well as for financial reporting. In the long run, for any product to be viable, its price must cover its full cost. So we know that if we're in the business of making money, then we obviously have to set a price higher than that what we're paying for whatever product or service we're providing, right? Okay, the importance of unit cost to service firms. Conceptually, the way companies accumulate and assign cost is the same whether or not the firm is a manufacturer. The service firm must first identify the service unit being provided. A hospital would accumulate cost by patient, patient day, and type of procedure. Service firms do not produce physical products. They do not need to value work in process and finished goods inventory. So that's nice. Service firms kind of takes out part of the components to the equation that we have to solve for. Okay, we're dealing with ethical decisions really with this chapter. Right here, nonprofits really need to be accountable to show how precise their operations are running, to show if they're really spending more money on what the actual not-for-profit is for whatever their goals or objectives are of trying to achieve, as opposed to how much money is actually being paid to administer the goals or the objectives, like management costs and all that. So they want to see that you're efficient with whatever money is being donated to a not-for-profit. So that's an ethical issue there. Government agencies need to track the funds wisely because they have an accountability due to the citizens, because most of their money is derived through taxes. So the citizens have a right to know where their money is being spent and what it's being used on. Okay. A cost accounting system measures and assigns costs so that all unit costs of a product or service can be determined. And obviously, we've established this is critical for both service firms and manufacturing firms. And it's saying here too, it ties into some Medicaid rules as well. So ethical decisions, I'm not really worried about touching on this a whole lot here. Just know you just always have to make decisions based upon ethics, because you always have to be concerned with whatever's happening in the environment or on other individuals or so on and so forth. Okay. I'm not going into here's how it's used in your life. Okay, normal costing and estimating overhead. So now we're going to get into our first little calculation here. In normal costing, overhead is estimated and applied to production. The basics of overhead application can be described in 3 steps. The first step is to calculate the predetermined overhead rate. The second step is apply overhead to production throughout the year. And step 3 is to reconcile the difference between total actual overhead incurred and then total overhead applied to production, okay? Predetermined overhead rates help companies maintain a constant application of overhead throughout the year, and these rates do not allow seasonality or variations in production to affect unit costs. So once again, those are the spikes we were talking about through the seasonal spikes around Christmas or around the summer when people were traveling a lot, stuff like that. Okay, so back to step 1, calculating the predetermined overhead rate, okay? So it says here that the predetermined overhead rate is calculated at the beginning of the year, and it's done so by dividing the total estimated annual overhead by the total estimated level of associated activity or cost driver. So we can see here that the actual formula is predetermined overhead rate equals estimated annual overhead divided by the estimated annual activity level. Now I just want to point out here, notice they're both estimates here on the numerator and the denominator, okay? Okay, it says here this estimation is necessary because the predetermined overhead rate is calculated in advance, usually at the beginning of the year, right? So we're going to calculate this at the beginning of the year because, like I said before, we know what direct labor is, we know what direct materials are throughout the period, just based upon the number of hours that people work or based upon the amount of material that we're purchasing, right? So this right here, the predetermined overhead rate, is what we're going to use to apply to whatever the cost driver is or whatever it is that we have to apply to, right? Whatever's specific to that firm. So it says here, estimated overhead is the firm's best estimate of the amount of overhead to be incurred in the coming year. So once again, this is the normal costing. We're going to try to just estimate it so we can kind of get a better estimate, okay? Step 2, applying overhead to production. So it says here, once the overhead rate has been computed, the company can begin to apply overhead to production. Applied overhead is found by multiplying the predetermined overhead rate by the actual use of the associated activity for the period. So once again, we can see this formula right here. So once again, applied overhead equals the predetermined overhead rate times the actual activity level. So remember, so we need this predetermined overhead right here. We find this for step 1 to be able to get down here to plug it in right here, right? So after that, the total cost of the product for the period is the actual direct materials, the direct labor, plus the applied overhead, right? So therefore, the total normal product cost equals actual direct materials, actual direct labor, plus applied overhead. And remember, the applied overhead is the estimate that we're going off of. And at any given point in time through the lecture, just tell me to slow down if I'm moving too fast for anybody, okay? Everyone okay so far? Okay, let's do a little exercise real quick. So how to calculate the predetermined overhead rate and apply overhead to production. So it says here, at the beginning of the year, Argus Company estimated the following costs. We have an estimated overhead of $360,000 and an estimated direct labor cost of $720,000. It says here that Argus uses normal costing and applies overhead on the basis of direct labor or direct labor cost. Direct labor cost equals total direct labor hours worked multiplied by the wage rate. So we know that. So for the month of February, direct labor cost was $56,000, okay? So let's just take a look at an example right here because we're going to work through another one out of the back of the book here shortly. So we're just going to take a look here. So calculate the predetermined overhead rate for the year. Remember, the predetermined overhead rate is this formula right here. Estimated annual overhead over the estimated annual activity level, right? So the overhead over the activity level, right? Predetermined overhead rate, remember? There's the 360 estimated overhead over and there's your cost driver, the 720. So in this case, the direct labor cost is what their cost driver is, right? So you do your math there, and it leaves us with the 50% direct labor an hour, right? Or 0.5. Everyone understands step 1 right there? Pretty straightforward. Anyone kind of stuck on that? Okay, step 2, overhead applied to the February production. Once again, we just we're at this formula right here now. Applied overhead, so we take the predetermined overhead rate, what we just found, the 0.5, and just multiply it by the activity level, the actual activity level. And in this case, It was the $56,000 direct labor cost in the month of February, okay? So now we're just taking the rate we just found from step one, the predetermined overhead rate, and just applying it to those hours that was earmarked for February, because that was the cost driver. Does that make sense? So that's step two. That gives us $28,000. Everyone seeing that? Okay. So remember that two types of overhead are recorded, right? We have actual overhead and applied overhead. Actual overhead, costs are tracked throughout the year in the overhead account, right? So actual overhead, we're gonna accumulate those in an account throughout the year. The applied overhead is going to be the costs that are computed throughout the year and added to actual direct materials and actual direct labor to get total product cost, okay? So the applied overhead is what we just went through in just the previous steps, right? That's the estimate we're making based upon the cost driver, right? At the end of the year, obviously, the chances of these two actually lining up and being the same are not very likely, right? So obviously, the applied and the actual overhead is most likely going to be different, right? Because obviously, one's an estimate, one's what's actually happened. So obviously, if that's the case, then we have a variance, right? So it's known as an overhead variance. A variance is just the difference between two different outcomes, right? So the difference between, in this case, they're saying if actual overhead is 400,000, so that's the actual amount of overhead throughout the year that was actually recorded, and then the applied production was 390,000. Then obviously we have an under applied overhead by $10,000. That's the variance, right? $10,000. But in this case, the applied was 390. So we were thinking, based upon our estimate at the beginning of the year, this is what we thought it was going to be when we applied, right, in our estimate. It was actually $400,000, so we under applied overhead because we missed the mark by $10,000. That makes sense? Same thing here. If actual overhead was the same, 400,000, but the applied was 410, then we over applied it, right? If overhead has been under applied, then the product cost has been understated. Makes sense? So if it's under applied, then the product cost was understated because we didn't cost it enough to reach what it should have been, so it was understated. Everyone good on the fact that the applied and the actual are most likely going to trigger a variance, and the difference between over and under applied? Once again, it says if overhead has been over applied, then product costs have been overstated. Once again, if the applied one's higher than the actual, then we've overstated the cost, right? So obviously at the end of the year, we have to do something with that variance, right? So usually if it's not a material amount, meaning it's really small, just in a nominal amount, like the dollar value is really little, we just adjusted the cost of goods sold at the end of the period, okay? So that's how we're going to adjust for those variances between the actual and the applied, okay? So here, under applied overhead is added to cost of goods sold, because if it's under applied, then our cost of goods was undervalued, right, or under costed. So we need to add it. If it's over applied, overhead is subtracted from cost of goods sold, which makes sense because we have over costed everything throughout the year, so we need to back it out of cost of goods sold. So once again, the variance is going to be, if it's not material, it's just adjusted directly to cost of goods sold. Okay. If the variance is, if it's large, then we have to actually break it down into the components of where it belongs, meaning work in process, finished goods, or cost of goods sold. And that's only if it's a material amount. Then we can't just say, okay, well, we're just going to expense it as cost of goods sold, or just increase it or decrease it. Then we have to itemize it where it belongs. Makes sense? Okay, this is just a visual, pretty much. Here's the actuals on both sides. This is the under applied, so obviously applied overhead would be under applied. Same thing, cost of goods sold under applied. It's just showing you a little visual there. Actual, you can see the over applied on this side, so I'm not going to bore you on that. Everyone can just see that. Just gives you a little visual there. So the cost of units sold and units kept in inventory are carried at historical cost. The difference between actual and applied overhead must be recognized, and total cost must be adjusted. So once again, that's what we were talking about right there. So obviously now that we know what we have to do with the variance, right, between the actual and the applied, it has to be adjusted in the cost of goods sold, right? So let's just look at a little example of how we would accomplish that, okay? So we're going to just build off the previous example with Argus Company, right? So remember the predetermined overhead rate we found earlier in these slides was 50% or 0.5, or if you recall, remember? By the end of the year, actual data, now this is what actually happened, right? By the end of the year, actual data was overhead of $375,400, direct labor cost of $750,000. So remember, before it was the estimates, and now this is what's actually happened. Cost of goods sold before adjusting any overhead variances was $632,000, okay? So calculate the overhead variance for year one. Go ahead and we'll get a little idea of what it would look like. So the solution for number one, the overhead applied for year one is 0.5 of 750,000, right? Because that's, remember, this is our predetermined overhead rate. $750,000 is our cost driver, remember, based on direct labor for this example. So there's the actual overhead was given in this previous slide. Actual overhead was 375,400. The applied overhead was 375,000. Remember, because that's our estimate based upon the rate we found, right? So obviously there's a $400 variance, right? So overhead variance is underapplied by $400. Why is it underapplied again?
Because actuals larger than applied.
Right, so we have an underapplied variance. So we know we have to adjust cost of goods sold for that, right? So if it's an underapplied overhead variance, then we obviously have to adjust cost of goods sold up, right? So we have to add that variance into cost of goods sold. So we just add the $400 to the beginning balance of cost of goods sold to bring it up to $632,400. Does that make sense? So once we can actually infer what the actual data was, we compare it to what we applied throughout the year, and then just take that variance, and then whether it's over or under, we just adjust it to cost of goods sold. Pretty straightforward, right? Anyone lost on how you reconcile the difference on the variance to cost of goods sold? Everyone good so far? Okay, so departmental overhead rates. So a plant-wide overhead rate or single overhead rate has been explained by dividing all estimated overhead for a factory by the estimated activity level across the entire factory. Okay, so now we're just looking at it on a broad spectrum now over the entire factory of operations, right? Some manufacturers and service firms believe that multiple overhead rates give more accurate costing information. Departmental overhead rates are a widely used type of multiple overhead rate. So pretty much what it's saying here, departmental overhead rate is just estimated department overhead divided by the estimated departmental activity level. So it's pretty much the same thing we've done before. Now it's just on the whole grand scheme of things, right? So it's pretty much same song and dance. Now it's just we're not applying it to an individual department. Now it's just for the whole department, right? Okay, so the steps involved in calculating and applying overhead are the same as those involved for one plant-wide overhead rate. So once again, it's the same thing. It's just we're just a larger spectrum is what it's for the whole factory now. Departmental overhead rates allow companies to recognize that different producing departments have different overhead costs. Okay, these rates allow more precise application of overhead as units pass through one or more departments. So let's look at one more little example here. So how to calculate predetermined department overhead rates and apply overhead to production. So we can see here we have machining department, assembly department, and then just the total working from left to right, right? And we can see here whatever the relevant relevant item is, here's overhead, direct labor hours, and then machine hours. So Sorrell uses departmental overhead rates. In the machining department, overhead is applied on the basis of machine hours. So in the machining department, it's based upon the machine hours, okay? In the assembly department, overhead is applied on the basis of direct labor hours. So on the assembly, obviously it makes sense. We're concerned with direct labor hours right here. So machining, machining hours, assembly, direct labor hours, okay? So actual data for the month of June are as follows. So here's actual data, remember? This is the actual data here. So for step one, calculate the predetermined overhead rates for the machining and assembly departments. And that's going to be based upon this data right here. So what do we, for the machining department, what do we think that the direct overhead rate, how are we going to find that based upon this data right here? Well, that's the total one. We're looking at just the machine one now. Remember, I said it was based upon the overhead based upon machine hours. So what do you think that would be? 240 over 200,000. Do you see that?
Yeah.
The 240, and then this is our cost driver here, the hours. So it's just going to be 240 over 200,000. That makes sense to everybody?
What do you mean by cost driver?
The cost driver is each unit is going to increase the cost, right? So that's driving the cost. In this case, for every hour the machine's running is driving the cost up, right? Same thing here on the assembly department. That's the cost driver. That goes back to like chapter 1 or 2, what the cost driver is, right? Does everyone remember that? But that's what it is. Cost driver is just whatever's driving the cost. In this case, like I said, machining department is machine hours. The longer we run the machine, the more it's going to cost us. The assembly department, the more direct labor hours are included, the more it's going to cost us. That's the cost driver, right? Make sense? Okay. So what do we think it would be for the assembly department? Right, because that's the cost driver, right?
Yeah.
So let's just look here. 360 divided by 240. So that makes sense on step one, the overhead rates, how we find it. And remember, it's the estimated annual overhead, right? Over the estimated annual activity, and that's based, those are the cost drivers, the activities. So that's just back to that formula, just knowing your formula, and you just plug them in. Make sense? Okay, for number two, calculate the overhead applied to production in each department for the month of June, okay? So for the month of June, so the first thing we have the rate, right? We found the rate in part one, right? So remember, this is just the predetermined overhead times the actual activity level. Okay, remember actual activity level. So now we have to go back to this slide. We have the rates we just found from step one, right? Now the actual activity level we have is right here, right? The actual activity level was 22.5, right? I'm sorry, I thought it was wrong. 17,000. That's the actual, because that's the cost driver we're looking at, right? That's the actual data, 17,000. So now we just take the rate we found and multiply it by the 17,000 right there. Same thing, overhead applied to assembly in June. We take the rate we found right here, and the same thing, the direct labor hours right here for the assembly department, the actual data right here. Multiply it by $20,000. Okay, so that's the actual right here. Okay. So we can see here the actual overhead versus the applied between the machining department and the assembly department. So the actual was given to us, right? The actual was given to us right here. And the applied, we found that, right? Based upon the rates and multiplied by the activity right here. We have those here. So obviously it's going to be an under applied overhead in this case right here because the actual overhead was more. Same thing we just looked at. And the under applied overhead is going to be the same here because the applied overhead was less than that of the actual overhead. Does that make sense? So pretty much all we're looking to do is find that variance. We just want to find that rate, multiply the rate by whatever the activity level is, the actual activity level, and then we just take the difference between the two. Does that make sense to everybody? And like I said, we're going to work out a problem or two from the back of the book here shortly once we get through the slides. But is that making okay sense just from seeing it on the slides? I know it's kind of hard to understand it when it's on the slides just being thrown at you like that. I just want to get through it before we actually start working the problems. Okay. Example 4.4, how to convert the department data to plant-wide data to calculate the overhead rate, apply overhead to production. So it says here, at the beginning of the year, Sorrell Company estimated the following. So once again, these are estimates, okay? Once again, the same thing, machining department, assembly department, and then here's the total, okay? Here's the actual data that we're concerned with now, okay? So now calculate the predetermined plant-wide overhead rate. I'm going to go back to this slide here. So now what's the plant-wide predetermined overhead rate? It'd be the total one, right? So what would be the case here? What's going to be? What are we going to look for here?
Would it be 600,000 over 575,000? Because you have to do most of them, maybe.
Just the driver. Just over the labor hours.
See, the only reason I said that is because if we're doing both departments.
I understand that. Yeah, and I would think the same thing too, but it's just, in this case, it's just the direct labor hours. But I would have assumed the same thing, that you want to add it to since we're doing total. Because last time we had to account for the 200 and then the 240, and now we're just leaving one out. Okay, so for the plant wide, we take the total overhead, the 600,000, right, over the 375,000 direct labor hours. Once again, this is actual data. So the 600,000 divided by the 375,000 direct labor overhead, or direct labor hours, I'm sorry. So it gives us $1.60 per direct labor hour. The second part says calculate the overhead applied to production for the month of June. That's our rate. And for the month of June, remember we're concerned with the month of June. 31,000 hours. You see that because that's for the month of June, so there's 31,000 hours. So we're just applying the rate to the actual hours used, just like we did earlier in the slides. The only difference now we're just doing it for the whole company instead, or for the whole department. Calculate the overhead variance for the month of June. Is obviously just actual overhead minus applied overhead, same thing. The actual was given to us, actual overhead, because remember these are the actual data. So there's their actual. And then the applied, we found it right here by finding the overhead rate. So are y'all following along with these steps here? So it's really not bad. Just find the rate, and then you just have to apply it to what the actual item is that you're looking for. Then you find the variance right here, and obviously we can see that it's 3,650 under applied because the applied was less than the actual. Everyone seeing that? Okay, unit cost in the job order system. The unit cost of a job is the total cost of the job divided by the number of units in the job. So once again, unit cost, total product cost divided by the number of units. So unit cost is total product cost divided by the number of units. So this is a job order cost sheet right here, okay? So here you can just see the Johnson's Leather Goods job order costing sheet. Job name, so they're producing backpacks here. Date started was January 3rd of the year. Date completed January 29th. Sorry. You can just see here the direct materials, direct labor, and applied overhead. So we're just doing the same thing we've been doing throughout the slides here. We're just accounting for it on a little cost sheet. So we add these together, we get the total cost, and then divided by the number of units will give us the unit cost. So it's the same thing as what we just talked about right here in the formula. Unit cost is total product cost divided by number of units. Obviously, total cost, once again, is your direct materials, direct labor, and your applied overhead in this case, because remember, we're using the normal cost. Does that make sense to everybody? Pretty straightforward on the job costing sheet, job order cost sheet. The job order cost sheet is subsidiary to the work in process account and is the primary document for accumulating all costs related to a particular job, which makes sense because each individual job we keep a job order cost sheet like that. So it just keeps track of all the costs that are going into whatever product we're producing. In that case, it was book bags. So what are the three things we're accounting for total product cost? Under normal costing, how do we find total cost, total product cost? Just the three items.
The actual direct materials, actual direct labor, and then applied overhead.
Right, and that'll give us total cost. How do we find the individual unit cost from total cost? Right, and that'll give us each individual unit. Everyone good on job order costing? Okay, it says here, as more and more jobs are produced, the company will usually find it convenient to number them. Obviously, we want to keep them numbered. Work in process consists of all incomplete work. We know that. In a job order system, this will be all the unfinished jobs. The balance in work in process at the end of the month will be the total of all the job order cost sheets for the incomplete jobs. So just all the incomplete job order cost sheets, if we just sum those up, that's going to be the balance in work in process. Does that make sense to everybody? Okay, next, the materials requisition form. So the cost of direct materials is assigned to a job by the use of a source document known as a materials requisition form. Okay, same thing here, just materials requisition number. We just have a number here to label it, the date, the department, and whatever job it is. In this case, it's a briefcase. Okay, and here you'll just see a description of what it is we're ordering, the quantity, the cost per unit, and the total cost. I'm sure everyone just throughout their time of life has ordered something from Amazon or something. You get your little shipment thing of whatever the material is that you've ordered and seen something. Or went to Lowe's and purchased lumber and it breaks down whatever your lumber or your screws or whatever it is. So same thing here. That's all we're talking about. Once again, the quantity type, I don't need to go through this. We can infer all the data based off just looking here. It's pretty straightforward. I think everyone's seen something like this. So is everyone cool on this to move on? Okay, next, the time ticket. This pretty much is like a time card for working. If you're on an hourly instead of salary, you have to clock in, clock out, punch in, punch out, however you want to talk about it. You have your start time, your stop time, and obviously it's job time ticket. That's number 8. You have the employee's name and then whatever date it is. The start time, stop time. So then the total time obviously is the difference between the two. The hourly rate, the total amount, and then what job number it's tied to. So we can keep track of the direct labor. So this is how we keep track of the direct labor. This is what the actual time ticket would look like. Pretty straightforward, right? So we know we can get these based upon wherever the time machine is. Usually it's done digitally within a system now. So we can just pull up the relevant date range, and it'll just give us all this data to get the direct labor. Pretty straightforward, right? Just time cards, reading the time card. Okay, I'm not going to go through these. Here's how it's used. There's 4 of them. Okay, flow of cost through a job order costing, and this is just a little flow of what's going on really on the statements. So here on the balance sheet, the materials account, this is just going to have your purchases and your materials used, right? That's going to be your materials account. On your work in process, you'll have subsidiary accounts, and that's going to contain your job order cost sheets, which is your direct materials and your direct labor. And we saw the direct materials from the materials requisitions form, where it showed the quantity and all that. So the materials requisitions form, we saw that right here. So that's what we're talking about down there. Next, the direct labor, that's coming based off the time ticket right there. So that's what's going to be in your subsidiary accounts down here for work in process. Once the jobs are completed from work in process, that's going to be held in finished goods. Finished goods, once they're sold, it goes to cost of goods sold, and that's obviously on your income statement. And then we'll also have selling and administrative expenses down here as well. So that's just a little visual of how it's flowing through the statements. Okay, so let's talk about accounting for materials, okay? So here's a little summary of raw material cost flow for the Johnson Leather Goods and its 2 jobs that it has going on. So you can see here at the top of the screen here, that's the raw materials account. So once again, the raw materials account is just beginning balance plus what we purchased, less direct materials charged to the jobs, remember? It's the same thing here for the materials. Purchases minus materials used. So that's all we're seeing right here in the materials account. Beginning balance, what we bought, and what we used to the jobs, right? So obviously if we started with nothing, bought 2,500, consumed 1,500, we have 1,000 in the ending balance. Does that make sense to everybody? Okay, now watch. Work in process account. So this less direct materials charged to jobs. So we have to move this 1,500 into work in process now, because obviously the next step from raw materials is work in process, right? So watch that 1,500 right here. 1,000 of the direct materials was for the backpacks. The other 500 was for briefcases. So there's where, when this is being depleted, that's where it's being replenished in down here in the work in process account. Everyone see that? Okay, the summary of the direct labor cost flows. So here's the wages payable account. Once again, remember this is based upon the time cards. Here we have direct labor hours for backpacks, 60 hours, 25 hours for the briefcases of direct labor. So total direct labor hours for both backpacks and briefcases is 85. The wage rate is $18, so we have a total of $1,530 of total direct labor. Everyone seeing that? So now all we have to do is just put wherever the direct labor belongs based upon the job. For backpacks, we have 60 hours at a rate of $18, which will be $1,080 for the direct labor. Next, we have 25 direct labor hours for the briefcases at 18 an hour, which gives us $450. Everyone's seeing how the labor is moving into it now, based upon the overall hours multiplied by the rate of each job. We're punching that in on the work in process account. That makes sense how it's flowing. Okay, so accounting for overhead. Overhead costs can be assigned using a single plant-wide overhead rate or departmental rates. We've already established that as well. We've seen both instances prior in this lecture. Typically, direct labor hours is the measure used to calculate a plant-wide overhead rate, and departmental rates are based on drivers such as direct labor hours, machine hours, or direct material dollars. So in the Johnson's Leather Goods example, a plant-wide overhead rate is calculated based on direct labor hours. So let's just assume in this case this is going to be our overhead rate of $4 per direct labor hour. Okay. So with that assumption, let's continue on with our little cost flows. Okay. So actual overhead account, because remember we want the difference between actual and the applied. So the actual overhead account, we have a lease of $200 per month, utilities of $50, depreciation on equipment is $100, and indirect labor of $65. So total actual overhead is $415, which is the sum of these items. The applied overhead account is the direct labor hours of 85 between the book bag and the other item we were creating, multiplied by the overhead rate of $4. So once again, that's the overhead rate that we did for the per direct labor hour. So that's where we're applying it to the total direct labor hours between the two goods being produced to give us total applied overhead of $340, okay? Now, out of the $340, we just want to just allocate them relatively between the two, the briefcases and the backpacks, based upon the number of hours worked for each one. I believe one was 60 years, and the other one was 25, I believe. So based upon that, multiplied by the overhead rate is will give us the 240 and the 100 in the work in process account. Everyone seeing that? Okay, this is a summary of costs transferred to finished goods right here. So you can see here at the top, it's work in process before the transfer of backpacks to the finished goods. So you can see here the backpacks are going to be moved to the finished goods, right? This here, the briefcases are going to stay. So you can see after we transfer the backpacks to finished goods, then the work in process account after the transfer only has the data for that of the briefcases down here. Then obviously the finished goods account is going to have the total cost of what was for the backpacks because that was moved to finished goods. So the total cost of $2,320 right here is where we get the completed backpacks of $2,320 right here. And in this case, there was no beginning balance, and we didn't sell any out of the completed goods. So the ending balance in finished goods is that of the balance of the backpacks. So the 2,320 moved down to here. Everyone seeing that? Does that make sense? How we moved through and created that worksheet, the flow of everything? Anyone lost on what we just went through? I'm just boring you all to death right now. Okay, this is a schedule of cost of goods manufactured for the direct materials right here. Obviously, we have beginning material, beginning materials and inventory, plus the purchases. That'll give us total raw material available. And then back out the ending raw material will give us the total use. So same thing of cost of goods sold. Beginning inventory plus purchases minus ending inventory gives us what was used, right? So there's total raw materials used based upon this formula. Direct labor given at 1,530. The overhead, once again, the lease, utilities, depreciation, and then the indirect labor. It's for a total of $415. And then here we back out the underapplied overhead of $75 to give us the overhead applied. Because remember, we have to back the variance out to get to the applied overhead. Then to get the current manufacturing costs, we just sum the three of these together because remember it's direct materials, direct labor, and the manufacturing overhead. But in this case, we want the applied, right? So this is pretty much just a breakdown of where you get each individual cost. Anyone confused on this right here? And then if we would have any beginning work in process, we would add that. In this case, we do not. So then we back out ending work in process of $1,050, and that'll give us cost of goods manufactured at $2,320. this chart, not the schedule of cost of goods manufactured, is that confusing anybody? Okay, statement of cost of goods sold, um, usually prepared at the end of each reporting period because obviously we have to be able to externally report it in the statements for the cost of goods sold and also to value our inventory being carried on the balance sheet. So this is just the statement of cost of goods sold. Once again, beginning finished goods inventory was 0. Cost of goods manufactured was 2,320, which we found right here on the schedule of cost of goods manufactured, 2,320. So goods available for sale in this case is 2,320, less ending finished goods inventory, which was 0 in this case. So normal cost of goods sold is 2,320. And now we want to add the under applied overhead of $75. Remember, because that's that variance, we need to bring our cost of goods sold up because the variance was under applied, right? So we under cost our goods throughout the year. So we need to add the under applied overhead back to get the adjusted cost of goods sold of $2,395. Everyone get that? Okay, so some brief job order cost sheets. These are a great organizational tool. The way companies keep track of the cost of unique jobs. Okay. Okay. So how to prepare a brief job order cost sheet? At the beginning of June, Galway Company had 2 jobs in process, Job 78 and Job 79, with the following accumulated cost information. So we can see here we have Job 78, Job 79, then we have all the materials, the labor, the overhead, and that's the balance as of June 1st. We can see right here, right? That's the sum of each one of these columns. So it says during the month of June, 2 more jobs, 80 and 81, were started. The following direct materials and direct labor costs were added to the 4 jobs during the month of June. So we can see here the direct labors, direct materials, job 80 and 81 were added. It says at the end of June, jobs 78, 79, and 80 were completed, but only job 79 was sold. So on June 1st, the balance in finished good was 0. So we want to calculate the overhead rate based on direct labor costs, okay? So in this case, we have to work backwards, okay? Because it says here, while the predetermined overhead rate is calculated using the estimated overhead and the estimated direct labor costs, in this case, those figures were not given. So we can work backward from the applied overhead and direct labor costs given in June 1 balance for job 78, okay? So job 78, direct materials and direct labor, right? So we're going to go off these numbers, I'm sorry, for the June 1st one. So using the formula, applied overhead equals predetermined overhead rate times the actual activity level for job 78. The applied overhead is $750. The activity level is $600, and we're looking for the predetermined overhead rate. So how do we find that based upon this formula right here?
Just divide 750 by 600.
Right. And that'll give us our rate that we need to find. So that's working backwards. Everyone see that? Okay. So the second part says prepare a brief job order cost sheet for the 4 jobs. Show the balances as of June 1st, as well as direct materials and direct labor added in June. Apply overhead to the 4 jobs for the month of June and show the ending balances. So once again, we got the beginning balance June 1st. Okay, these are given. Direct materials for each one, direct labor, and applied overhead. Okay, so this is what we're finding right here, the applied overhead, right? So the $500 is found by the 400 times the 1.25. Remember, the direct labor is the cost driver, right? So we're just multiplying it by the 1.25 that we just found. Same thing that we did before. It's just that we just had to work backwards for step one. And same thing for 1,750, 1.25 times the 1,400. 2,500 is the 1.25 just by the 2,000. So it's the direct labor. Everyone seeing that? Okay, so it says here by the end of June, jobs 78, 79, and 80 have been transferred out of work in process. So the ending balance in work in process consists of only job 81, right? So therefore, work in process June 30th is $820 because that's the only one left in work in process. So that's the total on June 30th at the end of the month. That's what the work in process is going to be because that hasn't been moved out. While 3 jobs, 78, 79, and 80, were transferred out of work in process and into finished goods during June. So only 2 jobs remain, 78 and 80. So finished goods on June 1 is 0. So 78 and 80, these 2 remain. So obviously finished goods are just those 2 jobs, the total of those 2 jobs, right? Same thing, 1 job, 79, was sold. So we just need the cost of goods sold of 7,310 based upon the cost for that job. So now we're just placing them where they belong, whether cost of goods sold, work in process, or finished goods. Everyone see that? Okay, so pretty much accounting for non-manufacturing costs. These are going to be the period costs we discussed with your general administrative and your selling expenses, okay? They're never going to be determined into your product cost, so that's pretty much what they're saying here, but it's still going to hit your income statement. So we'll see that down here. The selling expenses, administrative expenses is backed out after your gross margin. So that's all they're saying. We still have to count for these period costs, but it's not going to be included in the cost of goods sold. But it's still going to enter into the determination of net income. Oh, sorry. I just love moving that thing around. Of 335 in this case. Makes sense? I'm not doing here's how it's used. Okay, let's just talk about some journal entries, and we'll move through these relatively quick because I know this isn't financial accounting, it's managerial accounting, and most likely we're going to have a financial accountant that's going to be punching this data in into GL, but it's still good just to talk about it just a little bit. So we'll just run through them real quick. If we purchase raw materials on account for $2,500, we'll debit raw materials for $2,500 because that's our asset increasing, and credit accounts payable because that's a liability increasing, okay? Materials, we move $1,500 worth of materials into production, so we're going to move it into work in process and reduce the raw materials on the inventory account. Recognize direct labor costing $1,530. That's going to be charged into work in process, and then credit wages payable. Okay, so you notice this isn't just like a wage expense here. We're actually tying it into work in process because it's tied to the direct labor, right? Applied overhead to production at the rate of $4 per direct labor hour. A total of 85 direct labor hours were worked. So once again, this is going to enter into work in process. $340, which is 4 times 85, and then overhead control of $340. Incurred actual overhead cost of $415. So overhead control, $415. Then here's where the credits go: the lease payable, utilities payable, accumulated depreciation, wages payable. Everyone seeing that? Completed the backpack job and transferred it to finished goods. So now once again we're just moving it from work in process to finished goods. So we debit finished goods, reduce our work in process. That increases finished goods account. This reduces work in process account. Just swapping where it belongs. Sold the backpack job at a cost plus 50%. Here's the cost. So now we're just moving finished goods into cost of goods. So we're hitting our income statement for 2320. Reducing our finished goods. So when it's sold, we're just Finished goods move the cost of goods. That's the journal entry to accomplish it. Increases expense, reduces our finished goods on the balance sheet. And then the markup at 50%. So now we have an accounts receivable. That's an asset going up on the balance sheet. Sales revenue, that's the credit, that's money going up on the income statement. Revenue being added on the top line of your sales, that's causing it to go up. Everyone seeing that? Closed under applied overhead to the cost of goods sold. So once again, we're just moving it to the cost of goods sold and reducing the overhead control. Does that make sense to everybody? Okay, and then this is just posting it, the journal entries to the accounts. You can just follow the flow chart. I'm not going to really get into it. It's just showing the journal entries of what we just did and showing how it moves throughout the accounts. Okay, and obviously the relative debits and credits, like for the entry number 1, purchase raw materials, we debited raw materials, there's the debit, and then we credited accounts payable for $2,500, so we're just tying it to the direct accounts with what the debits and credit was. Pretty straightforward. Okay, we're getting there. Producing and supporting departments. Nearly every company or factory has producing departments and support departments. Producing departments are directly responsible for creating the products or services sold to the customers. So it says here an accounting firm could have a producing department of tax, of audit, or advisory, or consulting services. In a factory, producing departments are those that work directly on the products being manufactured, such as the grinding and assembly departments, okay? Obviously, the support departments are those that just provide support, right? So just like your general administrative and your selling expenses, stuff like that. Maintenance, grounds, engineering, housekeeping, stuff like that, where we can't directly tie it to either the labor or the material. Make sense? So producing and supporting departments. Okay, once the direct overhead costs of each department are determined, the next step is to assign the support department costs to producing departments by using casual factors or drivers. Department allows the firm classify each department as either a support department or a producing department, and then trace all overhead costs in the firm to a support department or a producing department. Assign support department costs to the producing departments using drivers that measure the consumption of support department services. Calculate predetermined overhead rates for producing departments, and then assign overhead costs to the units of individual products using the predetermined overhead rates. Okay, so we have 3 methods of assigning costs of multiple support departments here. The only 2 we're going to really even cover right now is the direct method and the sequential method. The reciprocal method is just, it's not really used at all in practice because of its, just because it's so sophisticated and it's difficult in its own way. So we're not going to be concerned with this one, just the direct and the sequential method here. So we'll talk a little bit about the direct method here. It says all factory costs must be included in product cost. Since support departments do not make the product costs or the product sold, their costs would not be added to the unit cost if they were not included in the cost of producing departments. The direct method is the quickest and easiest way to do this. So let's just take a look at what's going on here. Pretty much, once again, we have support departments and producing departments, right? So pretty much what we want to do is we want to allocate the support departments into the producing departments. That's all we're trying to accomplish here. And under the direct method, as you can see here, we're pretty much just dumping them directly in from the support departments into that of the producing departments, right? You can see here by the visual. So after allocation, obviously there's going to be no balance in the support departments, and it's all going to be in the producing departments, right? So let's look at this, departmental data. So this is how we actually assign it. So here's our 2 support departments, right? Support department for power, support department for maintenance right here. And these are producing departments for grinding, and then one for assembly. Here's the expected activity, the kilowatt hours and the maintenance hours down below here. And it says here, using the direct method, assign the support department costs to the producing departments, okay? So we want to move these costs over into these departments, right? So this is going to be the solution to doing so. For the power, we want to take the 600,000 for the power, okay? 600,000 over 600 plus 200. That's going to be the 600,000 because we're moving it to the grinding right here. 600,000 plus, or divided by the 600,000 plus the 200,000. So it's the over the total cost, right? Or the total hours. So 600,000 over the 800,000, okay? So that gives us 0.75 for the grinding. Everyone seeing that? For the kilowatt hours for the grinding, 600,000 over the total of both producing departments of 800,000. That gives us 0.75 as our ratio. Next, we want to do it for the assembly. In that case, it's 200,000 over the total producing departments for both the grinding and assembly, which is 800,000 again. That gives us 0.25. Maintenance, same thing. 4,500 over both these sums, the sums right here of 9,000. And obviously it's going to be the same for the grinding and assembly because the numbers are the same. Is everyone seeing that? So then the next step that we want to do is just use the allocation ratios for the power first. So we want to move this 250, right? We want to back this out of the support department and allocate it based on the relative percentages, right? So obviously 0.75 times 250 is 187,500. And then 0.25 times the 250 is 62,500. So how did we find these ratios again? Out of this data for the grinding department, how did we get 0.75 based out of this data right here?
Over 600,000 plus 200,000.
Right, because it's the total kilowatt hours for the grinding department over the total hours for both the grinding and the assembly department. So out of 600,000 out of 800 is obviously 0.75. Same thing, the 0.25 came from the assembly. Total kilowatt hours is 200,000, and out of the producing for assembly, out of the 800,000 for both the grinding and the assembly for the producing departments. That gives us the 0.25. So once again, that's how we get the ratios. And then how we move them over, just the ratios multiplied by the number we're moving. In this case, for the power, 250 times the 0.75 for the grinding, 250 times the 0.25 for the assembly, the 160 times the 0.5 for grinding, and the 160 times the 0.5 for the assembly, because they're both equal up here, 4,500. So they're both at 0.5. That makes sense to everybody? So now obviously there's no support activities going on anymore, right? It's all been moved into producing departments for either assembly or grind. Does everyone see how we allocated that based upon the percentage? Anyone lost on that? Okay, next is the sequential or step method. This recognizes that interactions among support departments occur. This does not fully account for support department interaction. Cost allocations are performed in a step-down fashion following a predetermined ranking procedure. The sequence is defined by ranking the support departments in order of the amount of service rendered from the greatest to the least, where the degree of service is measured by the direct cost of each support department. Okay, so once again, all we're wanting to do is move the support departments over into the producing departments, okay? But this time we're going to do it in steps as opposed to just dumping all the support departments directly into the producing departments. We're going to do it in a step this time. So we can see here, first we'll start with power, and we're going to dump it into maintenance, grinding, and assembly, okay? So that'll do away with the power. Then we take the maintenance and dump it into the grinding and into the assembly. And obviously that does away with the maintenance. So now the supporting activities are gone, and it's all on just the producing activities. Make sense? We're just going in steps now. We're allocating it to the 3, and then from 3 down to 2. Okay, obviously after we do all that allocation, now we have nothing left over in the supporting, and it's all been moved into the assembly, right? Okay, same thing here, pretty much what we did, but now we're doing it in steps. So now we just have to add one more step. So now we want to do the support departments for maintenance first. So that's going to be 200,000. We want to find our rate, right? 200,000 divided by the sum of these, what, a million? Okay, so that's going to be our first one. So that'll be 0.2. So 200,000 by that. Is everyone seeing how I'm doing that? Because that's the kilowatt hours for the support department maintenance, depending on all of the hours. So it's 20% of it. So that's how we get the rate. Next, we want to do for the grinding, 600,000 divided by the sum of these 3. Same thing for the assembly, 200,000 divided by the sum of these 3. And that'll give us our percentages right here. 0.2, 0.6, 0.2. Then we go back and do the same thing for maintenance, okay, for the $1,000 here we want to allocate. Obviously, it's going to be 0.5 right here because they're locked even, right? So they're going to be 0.5 is going to be our rate. Same thing there, 0.5 for the grinding and assembly. So next, all we do, same thing, the 250,000 right there, and just multiply it by the applicable rate. For the support, it's going to be 0.2 times 250 gives us the 50,000. It's going to be the 0.6 times 250 gives us 150. Once again, 0.2 times the 250 gives us 50,000. And obviously this is the 210,000 divided by 2 because it's each at 0.5. So it's the same thing. It's just now we just added in one other step and did it sequentially. Does that make sense on those? And once again, the reciprocal method just recognizes all interactions, right? But I'm not getting into that. It's barely ever used in practice because it's too cumbersome. So we'll just end right there for the actual lecture. So all we need to be familiar with is the direct method and then the sequential method. Okay, everyone seem okay with what we covered in the chapter so far? That's everything for the chapter, okay? Anyone lost on any particular item? Okay, so the next thing what I want to do is, everyone got their books with them? Huh? You don't have yours? Do y'all have a cell phone with you?
I do, but it's on like 1%.
It's on what?
It's on 1%.
Oh, it is?
Yeah.
Okay. I'll show the problem up here. Anyone else not have? You don't have yours. Do you have your phone with you? You got your book there, right?
Yeah.
I was going to say, anyone who doesn't can just take a picture and have a snapshot on it. Let me see here what page we're on. Okay, so page 193 is what we're on. And I'll put it up on top of the thing so you can see real quick. Okay, so everyone who's listening, just turn to page. We're on page 193 at the end of chapter 4, brief exercise 424. Okay, so can you all see that for 424? Okay, so it says refer to the information for Hallett Company above. Hallett uses departmental overhead rates, okay? In the cutting department, overhead is applied on the basis of machine hours. In the sewing department, overhead is applied on the basis of direct labor hours. Actual data for the month of June are as follows, okay? So we're going to be using the data up here along with the actual data down here, okay? Might want to grab a piece of paper real quick. So based upon this data, try to calculate the predetermined overhead rates for the cutting and sewing departments. So I'm going to give you all just a couple minutes to try to work that out, and then we'll work through it together. Can everyone see that on the overhead? Okay, yeah, so we're on number 1 right now. Calculate the predetermined overhead rates for the cutting and the sewing departments. I'll be right back. I'm going to go get a piece of paper real quick. And if you all want, you feel free to talk amongst each other too. I have no problem with that at all. How y'all doing on the first one for number 1 on the predetermined overhead rates? I think y'all have it. Y'all want to try to work through it real quick? let's see what this looks like. Try to keep it on the same zoom. Let me just try to clear something back and forth. Okay, so the first thing it's asking us for is calculate the predetermined plant-wide, I'm sorry, wrong one. Calculate the predetermined overhead rates for the cutting and the sewing departments, right? Okay, so the first thing, what's the first thing we want to do?
Find the predetermined overhead rate.
So we'll say for the cutting department, this is number 1 of 4-24. Okay, so for the cutting department, okay, so what's, and I'll just go ahead and put overhead rate. Okay, so what's the first thing we're going to do to find the cutting department overhead rate? What's the first piece we need to pull from? So we're dealing with the cutting department right here, right? Is that that's going to be your numerator or denominator? That's your numerator, right? So the overhead was what, $240,000? Okay, and we want to divide that by what?
Machine hours.
Machine hours, right? Which in this case was what, $150,000. Okay, and what does that leave us with? $1.60? So per machine hour. I'll just label it per machine hour. Okay, so there's the cutting department overhead rate. What about the sewing department?
Overhead divided by direct labor hours.
So the overhead, so that's the numerator, right? The 350. Okay, so we want to do 350. And what you said the other one? Direct labor hours of 100,000. Okay, and that gives us what? 350 per direct labor hour. Okay, so that's one, right? So now we have the department overhead rates, right? So now let's try number 2. So let's calculate the overhead applied to the production in each department for the month of June. Okay. So now we're going to be concerned with some data down here because remember for the month of June, now we're concerned with the actual. So based upon this data, so calculate the overhead applied to production in each department for the month of June. So we're concerned with both departments here. So what's the next thing we have to do here? I'll let y'all have a second unless y'all have already started working on it.
We'll do the same thing as the top, right? Or is this one you multiply?
This is the one where we had the rate. We found the rate first, right? Because remember, this is a different step process. This is the first one we worked out in class. So this is the 3-step process. Remember, the first thing we found the predetermined overhead rate. So that's given. So the next thing we have to use that rate and multiply it by the cost driver. Remember. So in this case, let's say for number 2 is what we're on now. So let's say overhead applied to cutting in June. Okay, so we know we've got the rate, right? So the cutting department is what we're talking about, right? So the rate was 1.6, right? So we'll take the 1.6 and multiply it. But what are we going to multiply as far as this is concerned? Remember, now we want to apply it to the actual data because this is the actual data for the month of June is right through here, and we're concerned with the cutting department. What's the driving factor for for the cutting department here. Machine hours, right. So we want to multiply it by the machine hours of 13,640. Everyone get that? Okay, what about for the sewing department? What are we going to do? So once again, we have our rate, right, for the sewing. We found it at 3.5, right? So this is for sewing. And that was, the rate was 3.5. And now what is the cost driver for the sewing department? Direct labor hours. So we just multiply it by the 8,600. Everyone see that? So not bad. You have to find your rate, right? And then you just multiply it by the cost driver, whatever that cost driver is. And it usually tells you in the problem, because I'm pretty sure it told us in this problem what each of the drivers were for each of the things. So that we good so far with steps 1 and 2. Okay, step 3, it says by how much has each department's overhead been over applied or under applied? So how are we gonna go about doing that? So first thing, let's go ahead and just set us up our departments, right? So we know we have the cutting department and the sewing department. Okay, so tell me the first thing we need to do after we set that up, if we're trying to find the variances here from actual to applied.
You just subtract the two.
Right, so first we'll just take some actual. Let's take what the actual was, and those are given to us, right? So the actual overhead for the cutting department, we can see here, because these are actual figures, was 20,610, right? Okay. The actual for the sewing department was 35,750. Everyone seeing that where I'm just pulling it directly off the chart? So now we've got our little charts here. This is the actual overhead. Okay, for the cutting and sewing, actual overhead. So next we need to back out what? Your applied overhead, right? So then we'll just do less applied overhead. Okay. And what was the applied overhead for the cutting department? Right. So it's the answer from step 2, right? 21,824. And what about for the sewing department? What was the applied overhead for the sewing department? 30,100 stands for step 2, right? Okay, right. 30,000. Okay, so now all we have to do is just determine the difference between these, right? So this one's 1,214. And now is this over applied or under applied right here?
Over applied.
Over applied. Why? Because what?
Too much.
Right. We actually over applied the cost throughout the year because it's the applied's more than the actual, right? So now that variance is 1,214 over applied. Okay, what about this one here? This one's $5,650. So which one's this one? Over or under?
Under.
This one's under, right? And why is it under again? Because it's less, right? The applied was less than what the actual cost was. That makes sense? Does it help seeing it in another problem just outside of the rambling of the slides? Does it help hearing it in the slides first, getting lost in the slides, and then seeing it instead of just jumping directly into a problem. Because believe me, I hate running through the slides as much as y'all hate me running through the slides, but I'm trying to cut them down and get through them as fast as I can. But this does help working out some additional problems. Okay. So now let me just ask you this. This isn't part of the question here, but let me just ask you, what do we do with these variances now? If they're not material, what do we do with them? At the end of the period. Because remember, now we have the actual and the applied. What do we do with the variance?
We either add or subtract the cost of goods sold.
Right. If it's not material, right? If it is material, what do we do with it? Proper landing place, pretty much, right? Either work in process, finished goods, or cost of goods. But for the most part, usually companies are just going to hit cost of goods sold for the most part, because hopefully, if you've done a good job on your applied overhead, you're not going to have a material amount. Because the whole point is to try to reduce that variance by as much as possible. So good job. That helps seeing that, right? Okay. Let's look next at brief exercise 426. It's on the same page. It's just skip the next one. It's on down. And this one actually continues over to the next page. So anyone need to take a picture of it so they can have it a little bit. And if you want, you can. I don't care if you want to sit next to someone so they have the book if you want to, or if you're good sitting there. Either way, I'm cool. I'm going to leave it up here and try to work there. Does someone want to take a picture of this, or you just want to look at the book? However y'all want to go about it. So once again, we're going to be working on brief exercise 426. And let me go ahead and adjust this so that everyone can see it for a second. I'll go ahead and just read it. So it says, at the beginning of June, Roan Company had 2 jobs in process, Job 44 and Job 45, with the following accumulated cost information. So Job 44, we can see we have the direct materials, direct labor, so on and so forth. Job 45, same thing, direct materials, direct labor, so on and so forth. It says during June, 2 more jobs, 46 and 47, were started. The following direct materials and direct labor costs were added to the 4 jobs during the month of June. We can see here on the bottom the relevant data. Okay, at the end of June, jobs 44, 45, and 47 were completed. Only job 45 was sold. On June 1, the balance in finished goods was 0. Okay, so the first thing we want to do is calculate the overhead rate based on direct labor costs. So calculate the overhead rate based on direct labor costs. Sorry, I'm trying to. So how's everyone doing on the first part of it? On the predetermined overhead rate. I'll give y'all a hint. This is the one where you have to work backwards for number one. Anyone think they have the first part of that one? What you got?
0.65.
Right. How'd you find that?
780 divided by 1200.
Right. Does everyone see that? So I'll go ahead and I'll work through it. I'll still work through it with you. Good job. So predetermined overhead rate, that's what we're finding, right? Okay, so what's the formula to find that in this case? Because we have to work backwards, right?
It'd be applied overhead divided by
Actual, actual activity, uh, the actual activity.
Which is the,
The,
let me move this out of the way again. So we have to find it for job 44 or 45, okay? In this case, it's going to be identical no matter which one we use. So we'll just go with 44 is what we'll go with. Is that the one you went with? Okay. So go ahead. What were you saying? It's what? What's your denominator?
the denominator is direct labor.
Direct labor. Right. Everyone see that? So the 780, and what was the 780?
Yeah, 780 by numerator. Like,
Right, right. Just making sure. So 780 is your numerator, your applied overhead over the direct labor of 1200, right? Okay, so we already said that that is 780 over 1,200, which gives us 0.650. So everyone gets that. Okay, good. Okay, now the second part. Sorry, just bear with me here. I know this thing is annoying. So it says prepare a brief job order cost sheet for the 4 jobs. Show the balance as of June 1, as well as direct materials and direct labor added in June. Apply overhead to the 4 jobs for the month of June and show the ending balances. And I'll go back here to this other page. And there's the data again. Y'all want to work through this one? Are y'all still working on it, or y'all are done? Okay. Anyone else want more time, or do you just want to get to the solution and just talk about it, or it's up to you. I'll give you all a few more minutes if you want it. Talk about it? Okay. Okay, so once again, it's saying prepare a brief job order cost sheet for the 4 jobs. Show beginning balance as of June 1, as well as the activity like the direct materials, direct labor that are added in June, and apply the overhead to the 4 jobs for the month of June. And then show the ending balances. Okay. So. Okay, so first thing I did is I just kind of drew a little at the bottom here. These are the numbers of jobs. Okay. Then I got the beginning balance June 1, the relevant information, which is going to be the direct materials, direct labor, and the applied overhead, and then we're going to eventually get to the total on June 30th, okay? So everyone following the chart that I set up there? Okay, now let's talk about the beginning balance as of June 1. So for job 44, we can see that the beginning balance June 1 is 7,080, right? So there's our starting point for job 44 on June 1. So that's going to be 7,080, right? Next, for job 45, we can see the beginning balance is 6,450 because that's balance as of June 1st, right? So we'll take that beginning balance. Man, I hate to get paper cut. Sorry. So the beginning balance for job 45, $6,450, right? So we'll write that in up here. At the beginning balance, $6,450. Okay, now what about jobs 46 and 47? What's the beginning balance there?
0.
Right, because they were started within the month of June, right? So there was no balance in the beginning there. So we'll go ahead and just put that down as 0. So everyone understands the chart here and understands where I got these beginning balance numbers right here. Anyone unsure on anything we've done thus far? Make sense to everybody? Okay, next, it says direct materials. So what about for job 44? What are the direct materials going to be? Right, and you got that, it's given, right? So it tells you the data down here. So 2,500, 7,110, 1,800, 1,700 for each relevant job. So all I'm going to do is just copy all the direct material amounts for each relevant job just directly into my table, okay? So for direct materials, job 44, $2,500. Job 45, 7,110. For 46, it's 1,800. And for job 47, it's $1,700. Everyone got that? So I just punched it directly in off the data that was given, right? What about the direct labor? It's given, right? So we just go on, we're just building our charts. So same thing, I'm just gonna go ahead and punch those in, just like I did for direct materials. So direct labor for job 44 is $800. Direct labor for job 45 is $6,400. $900 for job 46, and $560 for job 47. So everyone sees that, right? Okay, now, what about the applied overhead? Where do we get the amount for the applied overhead right here?
Multiply 0.65 times direct labor for every job.
Right. Everyone get that? So you see how it's pretty much same song and dance we're doing. It's just different setups pretty much to find different things that we're looking for. So how do we get the applied overhead again?
Direct labor times the 0.65.
Right. Because the rate's what we found in the beginning, right? That's right. So we just go through and do all those. So what's the first applied overhead for job 44? 520. And then so on and so forth. Just do the same thing. Apply the rate from step 1, the predetermined overhead rate, by the direct labor. So once again, for job 45, the 0.65 predetermined overhead rate from we found in number 1 is applicable to the direct labor and 6,400 of job 45. Everyone sees that? And so on and so forth. Okay, and obviously we just go through here. Next, we just add each up to get us from the beginning balance, add the changes throughout the period, and that'll give us the ending balance, right? So we just sum each column up here. First one, $10,900. Next one, $24,120. Next one, $3,285. And the last one, $2,624. Everyone get that? Make sense? Okay, what's the third part asking us for? It says calculate the ending balances of work in process and finished goods as of June 30th. So what's the sample time? Sorry. Calculate ending balances of work in process and finished goods as of June 30th. Y'all want to go ahead and talk about it? Work on it a little bit? What do y'all want to do? Everyone on the same page? Talk about it? Okay. So once again, we're finding the ending balances of work in process and finished goods as of June 30th, okay? So let's talk first about work in process. So what's it say about work in process? It says up here at the end of June, jobs 44, 45, and 47 were completed. Only job 45 was sold. On June 1, the balance in finished goods was 0. So what's applicable out of that data for this is at the end of June, jobs 44, 45, and 47 was transferred out of work in process, right? So if they were transferred out of work in process, then the ending balance in work in process is only going to consist of job 46, right? So therefore, the work in process of June 30th is just going to be the total for job 46. Does that make sense? Because that's the only one that was just left. So by default, it has to be just the only one that's in work in process. Everyone good on that? Because we removed jobs 44, 45, and 47, 46 still remains. So that's the work in process, the ending balance as of June 30th. Everyone good on that? Pretty simple, right? Okay, so for 3, work in process. For June 30th is going to be $3,285. And once again, that's because only job 46 is going to remain in work in process, right? The other ones were removed. So if they remove them out of work in process, then obviously it's going to be in finished goods, right? Okay. So what's next as far as is it finished goods? So what would finished goods be then? Finished goods on June 1. Let me go ahead and change the picture here, sorry. Okay, so finished goods June 1 we know was nothing, right? It was 0. Okay. So while there were 3 jobs, 44, 45, and 47 that were transferred out, right? Transferred out of work in process and into finished goods during the month. Only 2 jobs remain, right? So job 44 and 47. Everyone following me there? So obviously, finished goods June 1, nothing. Then we just add up jobs 44 and 47. So 44 was 10,900. So I'll add that back in. And then what was the other one? Was 47, 2,624. We add that one as well. That's job 44 and job 47, okay? So then this will be the finished goods on June 30th. So we just obviously just add these together, gives us $13,524. Everyone get that? Okay, so we have the finished goods June 1, 0, the 2 jobs left in finished goods, right? Because one was sold, one was still left in work in process. So these are the two left in here. So that gives us our balance June 30th, right? So next, we have to account for the cost of goods sold. Okay, so if jobs 44 and 47 are in finished goods, okay, and in work in process, we have job 46. So what has to be our cost of goods sold? Which one was sold? Job 45. So now all we do is just take job 45. That gives us our cost of goods sold. Make sense? So it'll be 24,120. Make sense to everybody? So once again, we find our predetermined overhead rate, right? In this case, we had to work backwards. Once you get the rate, then you just build your chart. You take what's given. You had the beginning balances were given, the direct materials, direct labor were given, and then we had to find the applied overhead based upon our found rate times the direct labor for each individual job. That'll give us that. Then we sum them up, and then we just follow through and we just place them where they belong. If it's still in work in process, we leave it in work in process based upon this ending amount. In this case, it was 3,285. For whatever the finished goods inventory, we just take our beginning balance. In this case, it was 0. Add in whatever goods were moved out of work in process but were not sold. That'll give us our finished goods inventory. Then obviously anything that was moved into finished goods and sold is what's going to be our cost of goods sold. And all the assignments of whether it's finished goods, work in process, or cost of goods sold is based upon the end of the month totals. Pretty straightforward. Once again, does that help see it in a different manner than just what's presented in the slides? Everyone good on that? Okay. We'll do one more and then we'll get out of here. That sound good? Okay, let's go to, let's see here. Just on the next page, brief exercise 427 on page 194. Again, I'll put it up on the thing here. I need to zoom in on that for y'all a little bit. Okay, so we're using this data right here for 427, and then here's your questions. Can you see that? I know it's kind of blurred. Everyone can see that okay? Okay, so it says Quillen Company manufactures a product in a factory that has 2 producing departments, cutting and sewing. and 2 support departments, S1 and S2. The activity driver for S1 is number of employees, so S1 the activity is number of employees. And then for S2, it is going to be S2 is the maintenance hours, so the maintenance hours will be for the S2. The following data pertain to Quillen. So we can see here we have the support departments, and then the producing departments, and then the relevant data for each of the 2 departments there. So the first thing they want us to do is calculate the cost assignment ratios to be used under the direct method for departments S1 and S2. So once again, each department will have 2 ratios, one for cutting and the other one for sewing, okay? And remember, if this is at the end of the slide, the last one we went over with the direct method. How's everyone doing on it? Need a little more time? I want to take a stab at it. Anyone think they have any of the ratios? We can start with S1. Anyone have, there's two ratios for both S1 and S2. What about S1 for cutting? It is. Yep. So how'd you find that?
The 63 divided by 63 plus 127.
Right. Yep. That's right. So I'll go ahead. I'm going to work through it as you said, but that's right.
Okay.
So let's see. For cutting, this would be number 1. And this is for S1. We'll start with cutting. So it's going to be 63 divided by 63 plus 147. And that gives us 0.30. So everyone sees that, right? So the 63, because we're doing it producing departments for, we want the cutting, so it's going to be 63 divided by 63 plus 147, because that's the relative percentage of that based upon the overall. Everyone got that? Okay, so if the cutting's 0.3, what about sewing? How would we go about finding sewing? What would that ratio be? 0.7, right. And how do we find that one?
47 divided by 15.
Right, which is the 147 by the 147 plus 63, right? So say the denominator's unchanged, it's just the numerator's changed now, right? Everyone see that? So once again, for sewing, it's going to be 147 divided by the same thing, 63 plus 147 equals 0.7. So everyone gets that right for S1. How we allocated those out. Anyone unsure on that step right there? Everyone good? Good. Okay, what about for cutting and sewing based on S2 now? Cutting's 0.8, right? How do we find that?
16,000 over 4,000 plus 16,000.
Right. So I'll go ahead and write that out. So for S2, cutting was 16,000 divided by the 16,000 plus the 4,000, and that equals 0.80. And then for sewing, what do we have for sewing now? 0.2, right? And how do we find that?
16,000 plus 4,000.
Right. So next to sewing is the 4,000 divided by the same thing, 16,000 plus 4,000, sorry, equals 0.20. Okay, so once again, for the ratios for number 1, for S1, the cutting was the 63 divided by 63 plus 147 gives us 0.3. For sewing, it was the 147 divided by 63 plus 147. Next, for the S2, the cutting would be the 16,000 divided by 16,000 plus 4,000 gives us the 0.8. And then we have the 4,000 divided by the 16,000 plus 4,000 gives us the 0.2. Everyone good on that? Makes sense to everybody? Okay, for part 2, it says allocate the support department costs to the producing departments by using the direct method. How's everyone doing on this? Y'all want to talk about it, or do y'all want to work through it a little more? Ready to talk about it? Okay. So it says here, once again, allocate the support department costs to the producing departments by using the direct method, okay? So first thing we want to do is we just want to build our little table up here, okay? You can see here that I have it. So I've got the support department, the producing department. Support department has the two divisions, S1, S2. Producing has the cutting and the sewing, okay? So I want to allocate the S1 and S2 to the cutting and the sewing, right? Because we're trying to move the support department's cost to the producing departments, right? That's the whole point of what we're doing right here. Okay, so the first thing I want to start with direct costs, okay? These are given right here. So I'm just trying to just move these costs into the producing departments to see what we have to add to these original costs, okay? So the first thing I'm going to do is just fill the direct cost in directly across, okay? So for S1, it's 180. I've already got that there for 180. S2, it's $150,000. The cutting is 122,000, so I'm just going to write that in here. And then the sewing is $90,500, okay? Okay, so everyone sees where I have that from right here, right? That's just directly given. Okay, and so once again, now what we want to do is we want to move the support department's cost and allocate them to the producing department, okay? So what's the next thing we need to do? So first of all, we know right here for S1, we want to move 180 out, right? So we want to do that right there. Okay, based upon this 180,000, how are we going to allocate that to the cutting and the sewing for S1?
54,000 is going to go to cutting, and 126,000 is going to go to sewing.
Right, and how did you get that?
Multiplying 180,000 by 0.3 for cutting, and
Right.
180,000 by 0.7 for sewing.
Right. Everyone see that? So the 180,000 times the S1.3 for cutting, okay, is going to give us the 54,000 over here. So we're going to move 180,000 of this money, 54,000 of it is going to go to cutting based upon the percentage that we found up top, right, for the allocation ratio. So obviously next of the 180,000, 70% of it's going to the sewing, right? So 70% of that is going to be 126,000, right? Good job. So what about S2 now? So we know first thing we want to do is we want to move the 150,000 that's related to S2 over, right? I'm going to go ahead and just sum these down so we know that's 0, right? After we move these over. But for S2, how do we allocate that cost over here to the cutting and the sewing?
80% for cutting, 20% for sewing, so that'd be 120,000 for cutting, 30,000 for sewing.
Right. Everyone see that? Anyone unsure on where we got any of that? Everyone clear on that? Okay, then obviously we just sum them up. 180 less 180, 0. 150 less 150, 0. Add these up, 296. And then add these up, 246.5. Make sense to everybody? You kind of see the pattern that we go through in this whole chapter. First you find your rate, then you apply it, and then either going to have your variance or where you have to allocate it to. You move it based upon your finished amounts at the end. If we have to move it to finished goods, work in process, so we're just punching it where it belongs. For the allocation from the supporting departments to the other with the direct method or the sequential method, either one. The sequential, we would just add a step to where we would be allocating something to S2, then to the other ones. like we did in the slides. It's just one step forward, but it's the exact same thing we just did on this one. Is there any content whatsoever in this chapter that anyone's just unsure about, or just does not feel like I explained it well, or anything of that sort? Everyone's okay? Everything makes sense for the most part. Okay, well, I'll go ahead and I'll get chapter 4's homework and quiz posted. So be on the lookout on that for Moodle. I'll make sure you have plenty of time to get that in. Once again, I appreciate your time in class. I'm sorry it's such a long, boring class. It's just, I'm trying to get through it and make it as fun as I can, but there's only so much you can do with the content. I hope everything's going well for everyone in this class and other classes. Once again, I'm pleased with the exam. Keep up the hard work. Once I look at all the grades that are in, I'll determine whether I'll be curving it or not. So I might curve it depending on it. This just depends what all the grades were in the course. So once I have time to evaluate all that, then I'll get back to you on that. So there could be a curve on the exam. But besides that, like I said, I'm happy with the progress. I think the exam grades overall were pretty well. I was pleased with them. And hopefully y'all are getting the material from chapters 1 through 3 and moving forward into chapter 4 so far. The good thing about it is there's not a comprehensive exam, so we won't have to see verbatim what we saw, but obviously, as you can see, the content's building upon the previous content. So I hope everything's making sense to everyone. I appreciate your time. I enjoy having you on in class, and just be on the lookout for the homework and the quiz, and just keep up the hard work. And that's all I have for everybody. So have a good evening and have a good remainder of your week. And as always, just give me a shout if you need anything. Okay.